Have you ever wondered how people get super mega rich by owning a slice of companies like Apple, Starbucks, Nike, and many others? Hi, welcome to this video. Have you ever wondered how people get super mega rich by owning a slice of companies like Apple, Starbucks, Nike, and many others? Welcome to Stocks 101. In this video, we will break down the stock market in plain English. No fluff, just the good stuff. Let's get started. Stock versus equity. A share or a stock is a unit of ownership in a company. If you own one share of Apple, you own one small piece of Apple. Think of a big pizza. If a pizza is the company, each slice is a share. The more slices you have, the more pizza you own. Equity. This is your total ownership stake in a company measured as value after liabilities. For example, if company X has total value of $100 million and owes $20 million, equity equals $80 million. If you own 1%, your equity stake is worth $800,000. Public company versus a private company. Public company is one whose shares are traded on a stock exchange. For example, Microsoft, Coca-Cola, Nike. Their shares are available to the general public. A private company is one not listed on a public exchange, owned by founders, VC firms, or private investors. For example, IKEA, SpaceX. Stock exchange and the ticker symbol. The stock exchange is where shares are bought and sold. Think of it as the Amazon or AliExpress for stocks. For example, the New York Stock Exchange and NASDAQ. The ticker symbol is the short code for a stock. For Apple, it is AAPL. For Amazon, it is AMZN. And for Tesla, it is TSLA. These abbreviations let you quickly find stocks in your app or broker dashboard. Portfolio and diversification. Your portfolio is your collection of all your investments, stocks, ETFs, etc. Basically, your basket or your cart of investment. Good portfolios diversify to spread risk. If your portfolio has Apple, Starbucks, and ETF that holds 500 companies, a dip in one won't devastate your entire net worth. A common stock versus a preferred stock. A common stock is the most usual kind, the one that most people are aware of. It gives you voting rights, dividends, that if the company does pay one, and price upside or downside. A preferred stock is less common, more stable dividends, but usually have no voting rights. Think of it as a safer but less controlled type of stock. For example, a company might issue preferred shares to institutional investors so they get reliable dividends, while common shareholders hope for a price growth. Dividends, yield, and return on investment, ROI. The dividend is a portion of a company's profits paid to shareholders. Take, for instance, Coca-Cola might pay $1 per share every quarter. Note that not all companies pay dividends. Companies like Microsoft, Pfizer pay dividends, while companies like Amazon and Netflix do not pay dividends. The dividend yield is the percentage return from dividends relative to the stock price. If a stock costs you $100 per share and pays $3 per share, the yield is 3%. The return on investment is how much your investment has gained or lost, expressed as a percentage. If you invest $1,000 and later it becomes $1,200, your return on investment is 20%. Compound interest. Compound interest refers to the earning of interest on interest. Growth accelerates over time. So suppose you invest $1,000 at 8% per year, compounded. In the first year, you then have 1,080. In your second year, you earn 8% on 1080, and that would give you 1166.40 and so on. In stocks, compounding comes from reinvested dividends and capital gains. Your risk tolerance and liquidity. Your risk tolerance is really how much volatility you can stomach without panicking. What is your risk appetite? Some people can sleep through a 10% drop while others will stress out at a 2% fall. We are all different. Find out who you are. Liquidity. How easy is it to convert an asset into cash? So for public stocks, most public stocks are very liquid. You can easily sell them. But say something like real estate or private equity, those are less liquid. So market orders versus limit orders. When you buy or sell, you can choose how, and there are two common types. So with a market order, you say, buy it now at the current best available price, it will execute immediately. For the limit order, if you say, I would buy only if the price drops to a particular price, say price X, or I will sell if the price rises to price G. Execution depends on price reaching your target. So if the price never gets to your target, your set target, the execution would not go through. Say, for instance, you want to buy a Nike stock only if it drops to $100. You set a limit order at $100. If that price never happens, your order doesn't go through. Market cap, earnings per share, book value, and intrinsic value. Market cap, which is the total value of all the company's shares, equals to the stock price times the number of shares outstanding. If a company has 1 million shares at $50 each, their market capitalization is $50 million. Earnings per share is how much profits the company makes per share. The formula usually is the net profit divided by the number of shares. If a company makes $10 million in profit and has 2 million shares, the earning per share is $5. The book value is the company's accounting value, that is assets minus liabilities divided by shares. If a company owns $100 million in assets and owes $60 million, their book value is $40 million total the number of shares. Now, the intrinsic value refers to what you believe a stock should be worth based on some fundamentals, not usually just the market price. For instance, analyze future earnings, growth, assets. You might estimate the stock's true value to say be $70, even if the market trades at $60. That is an intrinsic value. ETFs, index funds, and indexes. An index is the benchmark of many stocks. So think of an index as a playlist of the stock world. Just like you might have a playlist of your top 50 songs, an index groups a set of stocks in a category. An example is the S&P 500 is like a playlist of 500 of the largest US companies. Another one is the Dow Jones, which tracks 30 big industrial companies. The index itself doesn't trade. It's just a benchmark you measure things against. The index fund is built to replicate an index. Owning one gives you exposure to all the companies in the index. So an example, you have the Vanguard 500 Index Fund, VFIX. And why do people love index funds? It is diversified, low cost, and hands-off. Now, ETF is the exchange traded fund. It is like an index fund, but with extra flexibility. You can buy or sell it like a stock anytime the market is open. Many ETFs are index-based, so an S&P 500 ETF is essentially an ETF that stocks the S&P 500 index. There are also ETFs that track sectors like healthcare sector, the tech sector, or even regions and even themes. ETFs trade under ticker symbols as well, like you have SPY tracks the S&P 500, the QQQ tracks the NASDAQ 100. So I'll give you a quick analogy. So if an index fund is like a savings account that tracks a playlist, then an ETF is like a Venmo wallet full of songs you can buy and sell instantly. Capital gains. So the capital gains are the profits you make when you sell a stock for more than you bought it. If you bought a Starbucks stock for $70 and sold it for $90, your capital gain is $20 per share. If you hold for longer than a year, that's a long-term capital gain. And if it's shorter than a year, that's a short-term capital gain, and it's often taxed at a higher rate. Please take note of that. If you're thinking of investing, let's give it a summary. Now, think of investing like running a garden. The stocks are your plants, say apple tree, coffee bush, they are your plants. Your dividends are the fruits you harvest. The capital gains are the tree growing bigger over time. The risk tolerance is how much weather you can tolerate, the storm, the drought. Diversification refers to growing multiple different fruits in your garden, apples, berries, tomatoes. If one fails, you still have others. And compound interest is planting seeds from your harvest to grow more plants. Hopefully, with this, we have been able to cover all the terminologies that can help you start investing or clarify any doubts you might have in your heart. Thank you for riding through the stock market with me. I hope that you found this video helpful and insightful. Please feel free to share in the comment section what terms surprised you the most, which you'll be using and applying going forward. And if you found this video very helpful, go ahead and click on the like and subscribe button and put your comments in the comment section. Thank you. See you next week. Bye.
The Lord bless you and keep you. The Lord make his face shine on you and be gracious to you. The Lord turn his face toward you and give you peace. Numbers 6:24-26.